Before trends become headlines, before pressure becomes visible, there are signals. This channel studies those signals. For more than a decade, expansion felt natural. Growth felt like the default state of the system. Markets recovered quickly. Capital flowed easily. Risk was rewarded repeatedly. If something slowed down, stimulus appeared. If something broke, liquidity expanded. You internalized that pattern. You assumed recovery was automatic. But the pattern wasn't natural. It was engineered. After the 2008 crisis, institutions like the Federal Reserve and later the European Central Bank expanded monetary supply aggressively. Balance sheets grew. Interest rates fell toward zero. In some regions, below zero. Cheap capital changes behavior. When borrowing costs collapse, leverage increases. When leverage increases, asset prices rise. When asset prices rise, optimism compounds. Optimism attracts more capital. That cycle feels organic. But it is liquidity-driven. For more than 10 years, the system rewarded expansion. Companies expanded without immediate profitability. Startups raised capital on projections. Real estate appreciated consistently. Hiring cycles accelerated. You built your expectations during that era. Career progression expectations. Investment return expectations. Lifestyle expectations. You believed that growth was structural. But growth was synchronized with liquidity. Now examine what changed. Post-pandemic inflation forced a reversal. Liquidity contracted. Rates increased. Capital became selective. Institutions tightened. The cost of money rose. This is not a small adjustment. The cost of money is the price of risk. When risk becomes expensive, behavior changes. You will see it first in funding discipline. Second in hiring discipline. Third in asset repricing. Not collapse. Discipline. This is the first structural shift. The second shift is geopolitical realignment. Strategic tension between the United States and China has altered trade assumptions. Efficiency is no longer the only priority. Security is. Redundancy is. Resilience is. Those cost more. When global systems prioritize resilience over efficiency, margins compress. That compression travels through supply chains. Eventually, it reaches consumers. Then professionals. Then households. You begin to feel friction. Not dramatically. Gradually. The third shift is technological acceleration. Artificial intelligence is not hype. It is integration. It reduces certain forms of labor dependency. It increases productivity in specific sectors. When productivity rises unevenly, income distribution changes. Capital absorbs efficiency first. Labor adjusts later. The final shift is demographic pressure. Across multiple regions, workforce composition is changing. In some places, aging. In others, youth expansion. When labor supply expands faster than premium opportunity, negotiation power declines. Again. Not collapse. Compression. These four forces, liquidity discipline. geopolitical realignment, technological acceleration, demographic imbalance. They are converging. The late 2020s will not resemble the 2010s. Growth will still exist, but it will be selective. Capital will still flow, but it will demand proof. Careers will still advance, but only with positioning. The era of easy expansion has ended. This is not pessimism. It is structural recalibration. The environment is shifting. Most people will recognize it after outcomes change. You are recognizing it before. I don't give directions. I reveal the structure. What you do with it is your decision. This is underlying forces.